The recently passed Farm Bill will offer producers options on commodity coverage between ARC and PLC. ARC stands for Agriculture Risk Coverage, PLC stands for Price Loss Coverage. UNL Extension Public Policy Specialist Brad Lubben joined us earlier this week to discuss the two and what's ahead for farmers after a long wait for a new 5-year Farm Bill.
Well, for producers it means decisions. Lots of analysis, lots of decisions ahead. Commodity program changes, even conservation program changes really will require some new looks from producers.
Yeah, I read a recap of the new commodity programs with ARC and PLC, ag risk and price loss coverage, and I didn't have fun doing it. So I don't know how you do it on a day-to-day basis, but let's talk about some of these and the decisions that producers will make. And let's start in ARC, and they can use it on the county and the farm level. Explain how it works.
Well, it's interesting, Jeff. At least it's interesting for some of us to study, right? We knew a revenue versus price safety net was in the books, and even in 2008, acre versus the countercyclical was revenue versus price. The new ARC program is just a modification of that revenue concept. ARC at the county versus ARC at the farm protect a revenue calculation at the county level, a 5-year average yield times a 5-year average price times 86%, and there's your revenue guarantee, crop by crop, farm by farm, based on county numbers. If you want to choose ARC at the farm, it's a little more complicated. It's your cropping history and revenue from the last 5 years, and an Olympic average of your revenue from the last 5 years. So it's a sort of dependent upon the crops you've grown, that ratio of crops compared to your planted acreage. It's fundamentally sort of a whole farm safety net, regardless of how many crops, how many acres you have, a whole farm that you're trying to protect. That's what ARC at the farm does. ARC at the farm is not quite as lucrative perhaps as what we originally analyzed with language from last year because of some changes here. Instead of crop by crop, it's the whole farm. But it's still this basic decision. Do I want to protect revenue at the farm, or would I rather protect revenue at the county level? It's not a perfect predictor of farm results, but it does help you cover those widespread events like drought. Or do I want price loss coverage? If my focus is primarily on price and dependent upon what my price outlook is, maybe the guaranteed protection and price loss coverage is better protection if prices drop than an average guarantee based on revenue that might gradually decline over time. So producers have to make decision number one. Do I choose ARC at the farm and enroll the whole farm in it that way? Or do I look between ARC at the county versus price loss coverage and choose that on a crop by crop, farm by farm basis? Decision one. Decision two, all of these payments are tied to base acreage on the farm. I have to choose whether I want to update or not my base acres. I currently have a base acreage if I'm enrolled in the program. I have an option to update my base acreage, effectively reallocate it to the ratio of my plantings in 2009 to 2012. For many producers, that's a wise decision. It makes a base that's more reflective of what I currently grow, makes a risk management program more efficient. For some producers, they might say yes, but the expected payments on wheat base, for example, might be bigger than the expected payments on soybean base. So if my update decision would replace wheat for soybeans, maybe I'm happier keeping and staying in wheat. That's exactly the same kind of decision we made a couple farm bills ago. We get to do it again.
And what's the time frame for those decisions then?
Those decisions, as well as we should add a third one in there, updating payment yields, program yields, to a recent average, 90% of a recent average as well. All of that is part of the sign-up decision this year. We're still waiting on implementation and rules, and if things progress, we could imagine sign-up starting perhaps late spring, more likely early summer. Sign-up probably lasts through most of the summer. So we're looking at this, analyzing it, coming out with tools to help producers make decisions really over the next several months.
The crop insurance program, though, for this cropping season will stay like you would have for last year, correct?
Right. There were some substantial additions to the crop insurance program in the Farm Bill, all of which are starting with the 2015 crop year. So this year's decision on spring planted crops is the same basic decision that we've had.
And as we talked last time you were here, and we talked, I think, before it was officially signed into legislation, but the conservation program, you would expect to see those acres trimmed down yet again, or still, and that would stay force in Nebraska.
That's right. For the conservation title, we see increased funding in some areas, but we also see a shrinking cap on the Conservation Reserve Program. It shrunk from 39 million acres under the 02 Farm Bill to 32 million under the 08 bill to now 24 million under the 2014 Farm Bill. That's probably going to suggest another couple 100,000 acres or more of Nebraska CRP acreage gradually expires from the program and doesn't go back in. So we've had a transition over the last 5 years or so of maybe 500,000 acres. There's at least another couple 100,000 acres that have to make that decision about returning to production.
Coming up next week, first week of March,
right.
Cornhusker Economic Outlooks meetings. You'll be touring the state. Tell
right.
me and tell the audience what they could see if they attend those meetings.
Well, a longer discussion of this policy environment that we're living in, certainly now, with some details of producer decisions and analysis to come. But in addition to the policy outlook, a grain outlook, a livestock market outlook, a focus on land economics and leasing issues at the moment, sort of a general financial picture for Nebraska agriculture. A good, rounded outlook program, all packed in a 2.5-hour agenda in 9 spots across the state in 1 week. So,
Brad, along with UNL Extension livestock economist Kate Brooks and UNL Extension crop economist Corey Walters, will speak in 9 locations across Nebraska. The events are free and sponsored by the Nebraska Corn Board and Great Western Bank. For dates, times, and destinations, you can log on to agecon.unl.edu/CEO. We'll also link to that information on the Market Journal homepage.